$8 trillion. To comprehend the magnitude of this figure, you must realize it is more than the combined annual gross domestic product of Germany and Japan. It is a sum so vast that its sudden movement within the global financial system acts like a tectonic shift beneath the ocean floor, capable of triggering a tsunami that will wash away decades of Western prosperity. China has not just moved this money, they have repositioned it with a clinical, military precision. For 30 years, the world operated under the illusion of a permanent global partnership, a symbiotic relationship where China manufactured and the West consumed. That era has ended. What we are witnessing now is the final preparation for an economic event that has been decades in the making. This movement of $8 trillion is not a random reaction to market volatility. It is the fulfillment of a strategic directive that mandates a complete divestment from Western assets by late 2026. This is the invisible clock ticking in the background of every headline you read today. While mainstream media focuses on political theater and minor diplomatic skirmishes, the real war is being fought in the ledgers of central banks and the balance sheets of state-owned enterprises. The strategy is clear: liquidate Western exposure, accumulate hard assets, and build an alternative financial architecture that does not rely on the United States dollar. Historically, every time a rising power challenges an established empire, a specific four-stage pattern unfolds. This is a law of economic history, as predictable as gravity and as devastating as a physical invasion. We have seen this pattern destroy the British pound and humble the Japanese yen. We saw its early tremors when Russia weaponized energy against Europe in 2022, but those were mere rehearsals compared to what is happening now. China has studied these historical precedents with obsessive detail. They have learned that military might is secondary to financial leverage. If you control the supply chains, the debt, and the payment systems of your adversary, you do not need to fire a single bullet to achieve a total surrender. We are no longer in the early phases of this confrontation. We have passed the point of mutual benefit and the point of quiet accumulation. We are now deep within stage 3, the strategic repositioning. This is the most dangerous phase because it is the quietest. It is the phase where the trap is set, where the leverage is maximized, and where the exit doors are locked for everyone else. By the time the general public realizes the system is failing, the exit will have already been closed by the very institutions they trusted to protect their wealth. The timeline is no longer a matter of speculation. The order has been given. $8 trillion of institutional capital is currently being moved out of Western stocks, bonds, and real estate. This process is scheduled for completion within the next few months, leading into the pivotal year of 2026. This is not just another market cycle. This is the controlled demolition of the post-World War II financial order. In the chapters that follow, we will dissect exactly how we reach this precipice, why the Western response is mathematically doomed to fail, and how you can position yourself before the final trigger is pulled. The current crisis did not emerge from a vacuum. To understand why the collapse of Western markets is becoming inevitable, we must look back at the years between 1990 and 2010. This was the era of Stage 1, the foundation of dual dependency. During these 2 decades, the West entered into a Faustian bargain with China, driven by the pursuit of short-term corporate profits and the delusion of permanent peace through trade. American and European corporations, blinded by the promise of cheap labor and an untapped consumer market of over 1 billion people, began a systematic transfer of their industrial heartlands to the East. In 1990, China's share of global manufacturing output was less than 3%. By the end of this stage, it had surged toward 20%. This was not merely about making toys or textiles. It was the wholesale outsourcing of the Western middle class. Thousands of factories in the American Midwest and the industrial centers of Europe were shuttered. In their place, vast supply chains were constructed that stretched across the Pacific, making the West entirely dependent on China for everything from basic electronics to life-saving pharmaceuticals. This created a profound structural vulnerability that few in Washington or London were willing to acknowledge at the time. This dependency was not one-sided. While China became the world's factory, the United States became the world's consumer. This created a massive trade deficit that functioned as a giant conveyor belt, transferring trillions of dollars from Western consumers into the hands of the Chinese state. However, instead of spending those dollars, China did something much more strategic. They recycled that capital back into the Western system by purchasing trillions of dollars in United States Treasury bonds. By 2008, China had become the largest foreign creditor to the United States government. This was the trap being set. The West felt wealthy because it had cheap goods and low interest rates funded by Chinese savings, while China was quietly gaining the power to pull the plug on the entire American debt machine. Economists at the time called this chimerica. They argued that the two nations were so intertwined that conflict was impossible because it would mean mutual assured economic destruction. They pointed to the fact that American giants like Apple, Walmart, and General Motors were earning record profits through their Chinese operations. They believed that as China grew wealthier, it would inevitably adopt Western liberal values and integrate into the rules-based international order. They were catastrophically wrong. China was not integrating, it was observing. It was using this period of stage one to build the foundational strength necessary to survive the eventual separation. By 2010, the foundation was locked in. The West had lost its manufacturing base, its supply chain independence, and its fiscal discipline. It had become an empire built on debt, serviced by its primary strategic rival. Meanwhile, China had successfully transitioned from a closed agrarian society into the indispensable hub of global commerce. They had the factories, they had the technology transfers, and most importantly, they had the leverage of trillions of dollars in Western debt. The stage was set for the next phase of the pattern, the asymmetric accumulation. Between 2010 and 2020, the global economic landscape underwent a quiet but profound transformation. This was stage two, the asymmetric accumulation. While the West was preoccupied with the aftermath of the 2008 financial crisis and internal political divisions, China began building the strategic advantages that would eventually become weapons. They moved beyond merely being a factory for Western brands and began a systematic campaign to dominate the future of global trade and finance. The most ambitious component of this stage was the Belt and Road Initiative, launched in 2013. By investing over $1 trillion in infrastructure across more than 150 countries, China did not just build roads and ports, they built a parallel economic empire. These trade routes were designed to bypass Western-controlled maritime corridors and create a new center of gravity for global commerce. By financing these projects, China also turned dozens of developing nations into debt dependence, ensuring their political and economic alignment for decades to come. While the West focused on consumerism, China was focused on geography and infrastructure. Simultaneously, China began a quiet but aggressive diversification of its wealth. They recognized that holding trillions in United States Treasury bonds was a double-edged sword. While it gave them leverage, it also made them vulnerable to dollar inflation and Western sanctions. Consequently, they began shifting their focus from paper assets to hard assets. They moved to secure the global supply of critical minerals. Today, China controls over 60% of the global production of rare earth elements and a dominant share of the processing for lithium, cobalt, and nickel. These are the building blocks of the 21st century economy, from electric vehicles to advanced missile systems. Without China, the Western green energy transition and military modernization are physically impossible. In the financial realm, the accumulation was equally aggressive. China became the driving force behind the New Development Bank and the Asian Infrastructure Investment Bank, creating direct competitors to the World Bank and the International Monetary Fund. These institutions allowed China to offer alternative financing to the world, free from the conditions often imposed by Western lenders. More importantly, they accelerated the development of CIPS, the Cross-Border Interbank Payment System. This was the construction of a financial fortress, a system that could operate entirely independently of the Western SWIFT network. By the time the pandemic hit in 2020, the asymmetric accumulation was complete. China had achieved what no other power in history had. They had become the primary trade partner for over 120 countries. They controlled the supply chains for the most critical resources on Earth, and they had built a parallel financial system ready to be activated. The power balance had shifted invisibly. The West was still operating under the assumptions of the old world, while China had already built the tools for the new one. The trap was now fully armed, and the world was moving towards stage three, the strategic repositioning. To understand the magnitude of the $8 trillion move happening today, we must look at the first time this four-stage pattern destroyed a global superpower. In the year 1900, the British Empire was the undisputed master of the world. The British pound sterling was the world reserve currency, accounting for over 60% of global trade. London was the beating heart of international finance, and the Royal Navy guaranteed the safety of the seas. To the average citizen in London, the dominance of the British system felt as permanent and natural as the rising sun. However, beneath the surface, stage two was already reaching a boiling point. Germany, a rising industrial power, was growing at a rate that terrified British planners. Between 1890 and 1910, Germany's steel production surpassed Britain's, and its chemical and electrical industries became the most advanced on Earth. But the real threat was not just industrial, it was financial. Germany began a strategic repositioning that mirrors exactly what we see today. They realized that their dependence on the London-controlled gold market and the British pound was a strategic liability. Between 1900 and 1912, Germany executed a massive restructuring of its foreign reserves. They systematically reduced their holdings of British pound sterling by 60%. This was not a move driven by economic necessity, but by the preparation for conflict. In its place, the German Reichsbank began accumulating physical gold at an unprecedented pace, building the largest gold reserve in continental Europe. They were moving from paper promises controlled by their rival into hard assets controlled by themselves. They were building a financial war chest, preparing for the moment they would trigger Stage 4. The British elite, much like the Western leaders of today, remained arrogant and complacent. They believed that the sheer scale of global trade between Britain and Germany made war impossible. They argued that because British banks financed German trade and German factories supplied British consumers, neither side would dare to break the link. This was the great illusion. While British politicians gave speeches about eternal peace through commerce, German bankers were meeting in secret to discuss how to weaponize gold flows to trigger a liquidity crisis in London. The trigger was pulled in August 1914. When World War I began, the military conflict was immediately preceded by a financial nuclear strike. Germany and its allies withdrew their remaining capital from London and demanded gold. The Bank of England, which had operated for decades on the assumption of global trust, faced a catastrophic bank run. Within days, the world's most powerful financial system was on the verge of total collapse. Britain was forced to suspend the gold standard, effectively devaluing the pound and ending its era of undisputed dominance. The lesson for today is clear. Interdependence does not prevent war. It provides the weapons for it. Britain believed their financial system was a bridge to peace, but Germany saw it as a target for demolition. By the time the war ended, the pound sterling was a shadow of its former self, and the center of global power began its long migration across the Atlantic to the United States. Today, China is following the German playbook, but on a scale 10 times larger. They have seen how the pound fell, and they are now applying those same lessons to the dollar. The second historical example of this pattern occurred between 1950 and 1990, involving the United States and Japan. Following World War II, the United States rebuilt Japan as a strategic bulwark against communism in Asia. This was Stage 1 in its purest form. The relationship was characterized by deep interdependence. Japan provided high-quality, low-cost electronics and automobiles, while the United States provided the primary market for those goods and a security umbrella. For decades, this was hailed as the greatest economic partnership in history. By the 1980s, the pattern shifted into Stage 2, asymmetric accumulation. Japan was no longer just a junior partner, it had become an economic juggernaut. Japanese companies were not merely competing, they were dominating. But more importantly, the Japanese state had accumulated over $300 billion in United States currency reserves and treasury bonds. This gave Tokyo an incredible amount of leverage over American interest rates and the value of the dollar. While Americans were enjoying Sony Walkmans and Toyota sedans, Japan was quietly buying the debt that funded the American lifestyle. The strategic repositioning of Stage 3 became undeniable in the mid-1980s. Japanese capital began pouring into hard American assets. They bought the Rockefeller Center in New York, the Pebble Beach Golf Course, and major Hollywood studios like Columbia Pictures. To the American public, this looked like a trophy hunting spree by wealthy businessmen. In reality, it was a systematic move to convert depreciating paper currency into permanent physical assets within the heart of the American empire. Japan was diversifying its risk and building a position that would allow it to influence American policy directly. The climax came in 1987 during the event known as Black Monday. On October 19th, the Dow Jones Industrial Average plummeted 22.6% in a single day. While many historians attribute this to computer trading or irrational panic, a deeper analysis reveals the role of coordinated selling by Japanese institutional investors. They began liquidating their American holdings and moving capital back to the yen and gold. This was a demonstration of Stage 4, the controlled demolition. Japan proved that it could pull the rug out from under the American financial system whenever it chose. America survived the 1987 crash only through unprecedented intervention by the Federal Reserve and by forcing Japan into the Plaza Accord, which artificially manipulated currency rates. However, the lesson was not lost on China. Beijing watched as Japan's challenge was blunted because Japan was militarily dependent on the United States. China realized that to successfully complete Stage 4, they needed not only economic leverage, but also military and technological sovereignty. They saw the Japanese model as a blueprint for how to accumulate leverage, and they spent the next 30 years ensuring they would not make the same mistakes when their time came. We are now living through the most critical phase of the pattern, Stage 3. This is the moment of the great strategic repositioning, and it is happening with a velocity that should alarm every Western investor. The most significant data point in this phase is the recent movement of $8 trillion. This is not a theoretical number. It is the total estimated value of Chinese state-owned and private institutional capital currently being diverted away from the Western financial orbit. The objective is clear: total economic decoupling before the year 2026. The first pillar of this repositioning is the systematic dumping of United States Treasury bonds. For decades, China was the largest lender to the American government, holding well over $1 trillion in debt. In the last 24 months, that number has plummeted to below $800 billion, the lowest level in 15 years. China is not just selling. They are refusing to roll over maturing debt. They are sending a clear message to Washington: we will no longer finance your deficits. Every dollar they pull out of the American bond market is a dollar that the Federal Reserve will eventually have to print, accelerating the debasement of the United States currency. The second pillar is the aggressive accumulation of physical gold. While the official numbers from the People's Bank of China suggest they hold approximately 2,200 tons of gold, independent commodity analysts and movement trackers suggest the true figure is closer to 5,000 or even 10,000 tons. China is buying gold through secondary markets and private channels to avoid price spikes, effectively backing their economy with the only asset that has no counterparty risk. By moving $8 trillion out of paper and into gold and strategic resources, they are insulating themselves from the hyperinflationary collapse they see coming for the Western fiat system. The third and most dangerous pillar is the mandatory divestment order. In November 2023, the Chinese leadership issued a directive to state-owned enterprises and major private conglomerates to liquidate their Western equity and real estate holdings within a 3-year window. This is the reason we are seeing a sudden surge in Chinese sales of American commercial real estate and a quiet exit from European stock markets. They are liquidating at the top, taking Western cash, and bringing it home to fund their own self-sufficiency. This repositioning is being coordinated with a network of global allies. Through the expanded BRICS bloc, China is establishing a multi-currency trade system that ignores the dollar entirely. They have signed bilateral currency swap agreements with over 30 nations, including major energy producers like Saudi Arabia and the United Arab Emirates. When you can buy oil in yuan, the primary reason for the world to hold dollars vanishes. China is not just leaving the Western system. They are building a wall around it. They are preparing for a world where the West is an isolated island of debt, while the rest of the world trades in hard assets and sovereign currencies. We are deep in stage 3, and the window to prepare is closing. While the movement of $8 trillion represents the ammunition, China has spent the last decade building the delivery system. In this phase of stage 3, the focus has shifted toward financial infrastructure. For over 50 years, the West has maintained global dominance through its control of the plumbing of international finance, the SWIFT messaging system, and the New York clearinghouse. This infrastructure allowed the United States to enforce its foreign policy by simply cutting off an adversary's access to the global economy. China saw this as a strategic bottleneck and has now successfully engineered a way around it. The primary weapon is CIPS, the Cross-Border Interbank Payment System. Launched in 2015 and accelerated significantly since 2022, CIPS is more than just a competitor to SWIFT. It is a replacement. In 2023 alone, CIPS processed over 150 trillion yuan in transactions, a 50% increase from the previous year. It now connects over 1,400 financial institutions across more than 100 countries. This means that a bank in Brazil can now settle a trade with a factory in Shenzhen or a refinery in Saudi Arabia without a single cent ever touching an American bank or being subject to American jurisdiction. Complementing this is the digital yuan, or ECNY. This is the world's first major central bank digital currency, and it is designed for one specific purpose: to bypass the Western banking system entirely. Unlike credit cards or traditional wire transfers that rely on Western intermediaries, the digital yuan is a peer-to-peer programmable currency. It allows for instantaneous cross-border settlement that is invisible to Western regulators. As of 2024, over $250 billion in transactions have been processed using this system. It is not an experiment anymore. It is a functioning alternative to the dollar hegemony. Furthermore, China has weaponized physical infrastructure through its control of global ports. Under the Belt and Road Initiative, Chinese state-owned companies now own or operate over 100 ports in 60 different countries. From Piraeus in Greece to Gwadar in Pakistan and Darwin in Australia, China has secured the physical nodes of global trade. If Stage 4 were to be triggered tomorrow, China would not just stop shipping goods, They could effectively deny Western vessels access to the very ports required to sustain global supply chains. This combination of digital payment systems and physical trade nodes creates a closed loop. China has built a world where the West is no longer the indispensable middleman. They have successfully decoupled the plumbing of the global economy from Western control. This is the final preparation before the controlled demolition begins. By creating a system where they no longer need the dollar to buy oil, grain, or minerals, they have rendered the primary Western weapon, financial sanctions, completely obsolete. The trap is not just set. The exit for Western influence has been welded shut. Stage 4 is the final act of the pattern. It is the moment when the rising power stops repositioning and starts acting. This is what we call the controlled demolition. It is not an accident or a market correction. It is a deliberate, synchronized strike designed to collapse the economic dominance of the established empire. Having moved $8 trillion into a safe, insulated position, China is now prepared to pull the three primary triggers that will dismantle the Western financial order. The first trigger is the bond market shock. By dumping the remaining $800 billion of United States treasuries in a single, coordinated wave, China will create a massive supply glut that the private market cannot absorb. This will cause bond prices to crater and interest rates to spike instantly. Because the United States government is currently carrying over $34 trillion in debt, even a small increase in interest rates makes the debt unserviceable. The Federal Reserve will be trapped in a mathematical nightmare. Either let interest rates rise and cause a total systemic depression, or print trillions of dollars to buy the bonds, which will trigger hyperinflation. There is no middle ground. The debt itself becomes the weapon that destroys the currency. The second trigger is the strategic supply chain freeze. China does not need to stop all trade to destroy the West. They only need to restrict the flow of critical components. By leveraging their control over 90% of rare earth processing and 60% of global manufacturing, they can implement strategic export bans under the guise of national security or environmental protection. This would halt production in Western aerospace, automotive, and technology sectors almost overnight. Imagine a world where semiconductors, pharmaceutical ingredients, and battery components simply stop arriving at Western ports. The resulting inflation and industrial collapse would be faster and more severe than the 1973 oil crisis. The third trigger is the activation of the alternative life raft. This is the most sophisticated part of the demolition. As the Western markets descend into chaos, China will offer the rest of the world a choice. Stay with the collapsing dollar system, or switch to the stable gold-backed, CIPS-based yuan system. Dozens of nations in the global south, already weary of Western sanctions and debt traps, will migrate their trade to the Chinese system to ensure their own survival. This will result in the sudden and permanent loss of the dollar's reserve status. Once the world no longer needs to hold dollars to buy goods, those trillions of offshore greenbacks will flood back to American shores, creating a domestic inflationary wave that will wipe out the savings of the middle class. This is the reality of Stage 4. It is a calculated strike against the vulnerabilities that the West spent 30 years building. By the time the first trigger is pulled, it will be too late to respond. The West's military cannot fight a supply chain freeze, and its politicians cannot legislate away a mathematical debt crisis. The $8 trillion move was the final preparation for this event. The demolition is not just a possibility, it is the logical conclusion of the pattern we have observed throughout history. Everything we have discussed, the 4 stages, the historical precedents, and the movement of $8 trillion converges on a single point in time, the year 2026. This is not a date chosen at random. It is the result of a precise alignment of economic cycles, political deadlines, and mathematical limits. To understand why China is accelerating its timeline, we must look at the convergence of 3 specific factors that make 2026 the optimal window for the controlled demolition of Western markets. The first factor is the mandatory divestment deadline. As we have analyzed, the Chinese Communist Party has ordered its state-owned enterprises to complete their exit from Western markets by late 2026. This 3-year window, which began in late 2023, provides just enough time to liquidate massive positions in real estate and private equity without causing a premature global panic. By the time the calendar turns to 2026, China will have converted its most vulnerable paper assets into hard commodities and domestic self-sufficiency. They will be in a position of maximum strength, while the West remains in a position of maximum exposure. The second factor is the American debt ceiling and interest expense death spiral. By 2026, the United States government will be facing an unprecedented fiscal crisis. With debt projected to exceed $36 trillion and interest payments surpassing $1.5 trillion annually, The cost of servicing the debt will officially become the largest item in the federal budget, exceeding both Social Security and military spending. This makes the American system incredibly fragile. Any external shock, such as a coordinated sale of treasuries by China, will be impossible to manage. The system will be like a forest in a severe drought. It only takes one spark to start an uncontainable fire. The third factor is the geopolitical cycle. The year 2026 precedes the next major political cycles in both the United States and China. Historically, rising powers prefer to trigger major economic shifts when their adversaries are domestically distracted or divided. By striking in 2026, China exploits the pre-election instability in the West, while their own domestic consolidation is complete. They have spent the last decade building the BRICS Plus alliance and the digital yuan infrastructure to ensure that when the demolition occurs, the rest of the world has a functional alternative ready to use. The $8 trillion move is the final chess piece being put into place. When you look at the data, the speed of gold accumulation and the decline in treasury holdings are both accelerating as we approach this date. This is no longer a slow-motion shift. It is a sprint toward the finish line. Every day that passes reduces the West's ability to respond and increases China's leverage. The convergence of 2026 represents the end of the transition period. It is the moment when the strategic repositioning ends and the new global order begins. If you are waiting for a sign that the world is changing, you are looking at it. The clock is running out. We have analyzed the pattern, the history, and the timeline. Now, we must address the most critical question. How do you survive the transition? When $8 trillion moves out of the Western system, it creates a vacuum that will pull down traditional investment portfolios, pension funds, and savings accounts. The strategies that worked for the last 40 years, the era of dollar dominance and cheap global supply chains, are the very strategies that will lead to financial ruin in the next decade. To survive and thrive, you must shift your mindset from growth to preservation and strategic positioning. First, you must recognize the end of the 60-40 portfolio. The traditional mix of 60% stocks and 40% bonds is a death trap in an environment of rising interest rates and debased currency. Bonds, in particular, are no longer a safe haven. They are a direct exposure to the very debt crisis China is weaponizing. You must prioritize hard assets with no counterparty risk. Gold and silver have been the ultimate crisis hedge for 5,000 years for a reason. Central banks are currently buying gold at record rates because they know what is coming. You should follow the smart money. Physical precious metals, held outside the banking system, are your primary insurance policy against the controlled demolition of the fiat dollar. Second, you must position for the great reshoring. As China weaponizes supply chains, the West will be forced to rebuild its industrial base at any cost. This is not just a political necessity. It is a matter of national survival. Companies involved in domestic manufacturing, semiconductor fabrication, and defense technology will see massive capital inflows as the world decouples. This is a once-in-a-century shift in industrial policy. While the broader market may crash, the sectors dedicated to national self-sufficiency and energy independence will become the new pillars of value. Look for companies with tangible assets and critical utility that do not rely on Chinese components. Third, you must diversify your currency exposure. Holding only United States dollars is a high-stakes bet on the survival of a system that is mathematically failing. Consider allocating a portion of your liquid wealth into the currencies of neutral, resource-rich nations with sound fiscal policies, such as the Swiss franc or the Singapore dollar. Furthermore, Bitcoin has emerged as a decentralized alternative to government-controlled money. While volatile, it serves as a digital version of gold that operates outside the CIPS and SWIFT battleground, providing a potential exit ramp from the systemic collapse of traditional banking. Finally, prepare for the physical reality of a supply chain breakdown. This is not about being a doomsday prepper, it is about being a rational realist. If Stage 4 involves a strategic freeze on exports, we will see shortages of medicine, electronics, and specialized equipment. Ensure you have a 3 to 6 month supply of critical necessities before the panic begins. The insiders have already begun their move. We see it in the data of family offices liquidating Western equities and moving into private credit and hard commodities. They are not waiting for the news to confirm the pattern. They are acting while the liquidity still exists. The movement of $8 trillion is a signal. It is the final warning before the transition from the old world order to the new one becomes permanent. History shows that in times of great collapse, wealth is not destroyed. It is merely transferred. By understanding the pattern and recognizing the convergence of 2026, you have the opportunity to be on the right side of that transfer. The countdown has begun. The system is repositioning. The only question is, are you ready?